Today, Powell didn't say a single word about interest rates and somehow managed to get traders all over the world excited. How can a speech that says nothing new push global markets to rate price for a December rate cut? On the surface, it's only talking about Schultz, not about rates. Underneath, it's really about this. The Fed is flying blind. Markets are front-running, and your assets are standing at a new crossroads. At 9 a.m. on December 2, 2025, at Stanford University, during an event honoring former Secretary of State George Shultz, Powell shows up in a dark suit, scripted in hand, and speaks for 12 minutes. 3 main points. First, he talks about pragmatism. He cites Schultz's style, letting data speak, and says good policy relies on evidence, not slogans. Second, he talks about anti-discrimination and inclusion. He recalls Schultz's role in pushing labor equality orders in the 1970s, praising the idea that inclusive employment makes the labor market more resilient. Third, he talks about personal integrity. He mentions the word integrity 3 times and quotes the now widely repeated line, "Integrity is the collateral for trust." The subtext is clear. Once public officials lose credibility, the cost of policy rises exponentially. It all sounds elegant, political, commemorative, but the one line markets actually cared about, will we cut in December? He didn't say a single word. This is at least the 4th time this year he's deliberately dodged monetary policy in a public setting. Why? Because we've officially entered the 10-day blackout period before an FOMC meeting. And by rule, policymakers aren't supposed to signal anything about the economic outlook or rate path. What makes it worse? Since October, the government shutdown has delayed key data, labor reports, inflation prints, so the Fed is effectively flying blind. With no hard data, any hints of forward guidance were grabbed, exaggerated, and traded by markets. So in those 12 minutes at Stanford, Powell would rather only talk about Schultz, integrity, and evidence than using even a single adjective about the economy or rates. My take is simple. The key to this speech isn't what he said. It's what he very deliberately did not say. The chair stays silent. The market doesn't. Let's look at the pricing now. According to the CME FedWatch tool, the implied probability of a 5 BPS rate cut in December has jumped to the 80% to 87% range. Just a week ago, that number was only about 30%. Back then, Wall Street was almost unanimous. Forget a December cut. The earliest is January. And yet in 1 week, the narrative flipped. Who led that move? Bank of America. Late Monday night, they changed their call from no move in December to cut to 5 BPS in December, and then drew a whole curve. The punch of that quote lies in 2 things. It frames the cut not as a sudden U-turn, but as a path that has been sitting in the dotted plot all along. It upgrades a personal comment to a Powell plus majority of voting members consensus. If you're a trader, what do? You buy bonds early, push down yields early, add leverage early. That's exactly what markets are doing right now. You can think of today's U.S. bond market as one big race to reserve your seat on the easing train. OIS overnight index swap rates tied to the December meeting have dropped sharply, with implied odds of a 5 BPS cut near 80%. The 10-year Treasury yield hit 4.03% at one point, a new low for the month. Monday's $69 billion 2-year Treasury auction was met with huge demand. The bid-to-cover ratio was the highest in 3 months. Later this week, there's another $70 billion in 5 years and $44 billion in 7 years coming. And big funds are already repositioning for monthly index rebalancing. An Oxford economics analyst said it plainly. The improved tone in front-end yields over the last few sessions helped clear the way for a strong auction. Translated, everyone's getting ready to buy into easing. And the equity side is just as telling. Last week, when FedWatch slashed December cut odds from 50% down to 30%, the S&P 500 fell to percent in a week. And people started dragging out the AI bubble and valuation bubble narratives again. This week, Williams says a few dovish sentences, cut odds explode to the 70% to 80% range. Speculators started betting that cheap money is coming back. And the major indices flipped higher almost instantly. Underneath, there's a simple and dangerous logic. As long as the Fed cuts, we can keep the bubble going a bit longer. 5. My view, this is a turning point in policy and in signaling. Looking at the whole story, I have 3 key takeaways. 1. This is not just a routine technical cut expectation. In a normal cycle, a rate cut is driven by clear data. Inflation down, jobs weak, growth soft, then policy reacts. This time is different. The data are patchy. The Fed itself admits it's flying blind. The shutdown delayed the stats. The September report is only being fully digested now. In November, December, markets are locking in a path while the data are incomplete. That's a dangerous signal. Monetary policy is drifting from data-driven to expectation-driven plus personality-driven. In other words, people are now trading on what they think Powell will do, not on what the economy is actually doing. That erodes the Fed's credibility over time. Williams' speech is really a shadow of internal consensus. A lot of people are treating Williams' remarks as just one dovish guy's opinion. I disagree. Judging from his long voting history, he's more like a megaphone for the chair's view. Right before the blackout, he picks a moment to speak. And first, he stresses rising downside risks to the labor market. Then, he plays down upside risks to inflation. Finally, he drops the line about moving policy closer to neutral. That's basically drawing a map for markets. From where we sit, jobs are now more urgent than inflation, so stop obsessing over CPI alone. What does that mean for you and me? It means the Fed is quietly shifting its weight from fighting inflation back toward protecting jobs and growth. That's a major directional turn. Once that's confirmed, this won't just be a one-off to 5 BP cut. It'll be the opening of an easing quarter. 3. The risk is still there. Inflation isn't dead. Tariffs are coming. I think the market is getting a bit too excited. The 2 points Morgan Stanley and Standard Chartered made are actually very important. First, core inflation on an annualized basis is still above 2%, which means you can't credibly declare mission accomplished yet. Second, if the Trump administration pushes tariff to 0.0 in 2026, a new round of higher import costs will reignite imported inflation. If, in that context, the Fed starts easing aggressively now, it's basically opening the door early for the next wave of inflation to come charging through. That's why the few holdouts saying no cuts in December aren't saying no cuts in 2026. They're just saying, we'd like to see a couple more data points before we commit to the turn. So after all of this, what do you do with it? If you're a regular investor or trader, I'd offer 3 directional ideas, not stock picks, but frameworks. Watch for 2 words in the FOMC statement, sustainable, toward 2%. As soon as those phrases line up in a way that implies we've basically done the job, the market will extrapolate the easing path even further. Don't treat this potential cut as the start of a new QE mega bull market. This looks more like a mistake insurance cut. Insurance against a hard landing. Insurance against policies being too tight for too long. With inflation not dead and tariff risks on the horizon, easing will come with conditions and brakes attached. Focus on the curve, not one single point. The spread between 2, 5, and 10-year treasuries will tell you what the market really believes about short-term cuts versus long-term growth. If the front end collapses and the long end doesn't move, the market is betting on short-term firefighting, no long-term confidence. If the long end also drops sharply, you need to worry that the market is sketching a recession line for the future. Silence is louder than any forward guidance. Let's go back to those 12 minutes today. Powell didn't mention inflation. He didn't mention jobs. He didn't mention rates. He just said integrity 3 times and quoted one line, integrity is the collateral for trust. For the Fed, trust is its currency. Once it's gone, no dot plot or press conference will really matter. Right now, with missing data, political pressure, and market anxiety, Powell is choosing silencito, respect the blackout rules and leave the real decision. For the FOMC table next week, markets have already placed their bets. The media have written their headlines. But the only person who can actually say 3 characters to 5 BP hasn't spoken yet. When that day comes, you'll realize these 12 minutes of saying nothing at all were always part of the story. This is your global macro watchtower. We don't chase emotional highs. We help you see the logic underneath. If this episode helped you, don't forget to like, subscribe, and share. And in the next one, we'll keep unpacking the Fed's next move.